How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody a little bit about CECL. Regulators have been, a little more concerned recently about credit quality, particularly as it relates to commercial real estate. And so I saw an article in Bank Director that basically asked the question, are regulators going to start to look at CECL processes a little harder? Like, are they going to look at how you're calculating certain elements within CECL and what what are you doing with your numbers? Are you really looking at how you're collecting stuff and processing it and the history and historical aspects, and so I wanted to take a look at this article real quick. I have looked in the past at CECL, and I did an episode a couple of months back where I basically said, hey, how is CECL working? How are things going so far? And like I said, now we're coming into this article here. So let's get into this for a second. So this basically says regulators scrutinize CECL processes at community banks. In upcoming exams, regulators are looking for evidence that community banks have improved and refined their CECL processes. So when the new loan loss model was adopted by community banks in 2023, regulators looked for a good faith effort. 2 years later, expectations are changing. The accounting rule known as the current expected credit loss model, or CECL, went into effect for most community banks in 2023. It was a major shift in how institutions calculate credit losses and was often a big undertaking for smaller institutions with limited resources. In response, examiners at the Federal Reserve look for kind of a good faith effort from executives when they set their initial allowance estimates in 2023. According to an accounting roundtable hosted by the Federal Reserve Bank of St. Louis in November of 2024. But as community banks gear up for 2025 exams, executives are expected to further refine and continuously improve their CECL processes and data, the Fed reported. The phrase good faith effort is familiar to Mandy Simpson, a partner and the leader of the accounting advisory team at Crowe. Simpson remembers federal banking agencies, particularly the Fed, promoted the phase when she was a professional accounting fellow in the office of the chief accountant at the office of the controller of the currency. But she recalls them saying another tagline alongside it, adopt and adapt. That phrase, she says, is where bankers are at today. So CECL requires banks to forecast the lifetime losses for their loans at origination, using models that include historical loss data, future economic forecasts, and other variables executives deemed relevant to loan performance and loss severity. The allowance for credit losses is the biggest, most judgmental estimate on a bank's balance sheet, says Ashley Ensley, a partner in the financial services practice at accounting and audit firm Forvis Mazars. She says that many of her bank's clients are entering a phase of model maintenance or revisions. These banks may not have had a final model in place until the end of 2022 and now have the time and information they need to refine that model. This can look like adjusting or incorporating economic factors or further segmenting loans to refine loss estimates. These adjustments have mostly resulted in immaterial changes to the estimated loss. She adds her clients who use the same vendor have also taken the intervening years to share their experiences and adjust their model or input based on feedback. But the Fed's accounting roundtable flagged that some banks' allowance estimates were not catching the institution's full credit risk, even as credit quality across the industry remains strong. That warning comes as regulators continue monitoring pockets of credit risk in areas like commercial real estate and consumer lending in their periodic risk publications. A survey of 2024 enforcement actions from the OCC and the Federal Deposit Insurance Corp suggests the Fed's assertion for both this and other issues. Orders that mention credit run the gamut from underwriting and risk rating to loan review and the allowance calculation itself. Ainsley suspects that some institutions may need to drill down into their loans to segment them better. One area where this has happened is in commercial real estate portfolios, where executives have segmented loans into multi-story office, owner-occupied, retail, and warehouse categories to demonstrate appropriate risk ratings and allowances. Executives need to properly risk rate their institution's loans and include how changes in underwriting could contribute to credit risk down the line. And executives should document these risks as well as their understanding of how the risks could impact the allowance estimate when discussing the allowance with examiners and the board. One major area of focus for the Fed during the roundtable was the subject of qualitative factors. Qualitative factors, often called Q factors, are variables that influence losses that aren't captured or incorporated into a loss model. Under the prior incurred loss approach, some community banks' allowance or loss estimates heavily relied on Q factors. Ensley says Q factors made up 80% to 90% of some of their clients' allowance estimates. Today, her clients are using far fewer qualitative factors to calculate their allowances than before, and those Q factors represent a smaller portion of the reserve itself. She says one reason is that community banks that use similar estimation methods in the past opted to use more complex models now from vendors to calculate CECL. Q factors remain an important way for executives to apply their judgment to a loss estimate and ensure their allowance captures all the risks they see. But in the accounting roundtable, the Fed flagged they've seen inadequate support for or identification of qualitative factors during examinations. Ensley says auditors have made similar observations. Before adoption, Simpson says some predicted that CECL would be the death of Q factors, but experience has borne out that that's not true. Going forward, Simpson and Ensley advise executives to document which of the potential Q factors listed in the standard are already captured in their base quantitative calculation, which Q factors they need to adjust outside of their model, as well as why they've elected to exclude certain factors from the calculation. Of course, a loss model is only a tool that can't make up for poor credit risk management or underwriting. CECL was intended to bring credit and accounting functions together, but Simpson points out that the credit department should inform the accounting estimate. Credit teams should provide information and documentation to the accounting team about a loan's underwriting, appraisals, and risk rating. Particularly for community banks, if it's not documented, it's not done, Simpson said. So there you have the article there, but there is there's a lot to unpack here with this. How much time do we have today? Oh, yeah, we don't have enough time. So let me go back to just the beginning for a second. So for decades and decades, if not 100 years, banks had, they would have loan loss provisions. And they would basically put money into the loan loss provisions with the idea being that, hey, look, when you hit a recession or you hit a down period, you have money there to help to offset the bank's losses on loans that will have to be eventually charged off. The problem with the way that things were done before is that you had this, things were uneven. So in other words, what would happen is, like, in good times, when everything was good, banks would not put enough money into the loan loss reserves. Now, why would they not do that? Because when they put money into the loan loss reserves, it reduces earnings. And, particularly if you're publicly traded, you might want to do what they call on Wall Street a little bit of window dressing. And you might want to, pump up your earnings, make them look, put the best, picture forward that you possibly can for the performance of the bank. And so a lot of times banks would play this game where they would put less, when the economy was rolling and things were going great, they put less money into loan loss reserves. Therefore, when the bad times hit, the little bit amount that was in the loan loss reserves would get taken up rather quickly. And then it would go into the bank's earning and then capital and then, potential bank failures and that kind of thing, so, and then it also compounds the bad times, because then the regulators would come in and say, oh, you need to put, you've got all these loans going bad. I get that your earnings are down, but now you got to put a lot more money into the loan loss reserves because you have all these loans going bad and you got foreclosures and charge offs and all this other stuff. And so then that would kind of double hit the bank's earnings. Like, the bank's earnings were already down because they're in a recession, but now they've also got to put more money back into the loan loss reserves because they didn't do it when times were good. And so you would have this total uneven kind of ebb and flow, if you will, these ups and downs of the credit cycle, the business cycle. And so the idea partially here with CECL was that, okay, we're going to smooth all this out, because what we're going to have you do is we're going to have you basically assume in a very real way that every loan that you make is going to go bad or going to get charged off at some point. So now you're looking at like the expectations on the life of the loan, and you're basically, the idea and again, this is the very quick, like 30,000 foot view. The idea is that, like, you're going to take a little money for each loan and automatically put it in the loan loss reserves. Thus, you're going to create a more stable kind of environment, so to speak, with the amount of money that you're putting in the loan loss reserves, and that you're putting the appropriate amount away in good times, so that in bad times you'll have the necessary amount there, so that things will continue to be more even over the course of say multiple decades. Now, the real question is whether CECL is truly working as intended, and that gets back to the topic here today. So now we've, like you said, at the beginning a couple years ago, the Fed was basically saying, hey, look, just put something in there, just get it up and running as best you can. We're going to go on this kind of, good faith that, you're doing the best you can, and you're going to get this thing implemented. But now we're at this period, what they're calling, kind of adopt and adapt. Okay, you've already adopted this thing, but now it's time to adapt. Now it's time to go in and refine it and really drill down on what's going on there. And CECL has a number of different methodologies. I think there were 7 different methodologies, 7 different ways to calculate. A couple of those methodologies proved to be a lot more popular than others. I think there's probably 1 or 2 that I would describe as the primary calculation methods. But then they get down into what they call the Q, the qualitative factors as opposed to quantitative. And so what we're seeing here is that, banks are using a lot more Q factors at the beginning. Now that's beginning to kind of pull back a little bit, obviously as refinement and as adaptation begins to take hold here. So I think the important thing to note here is that, hey, look, if you got a bank exam coming up this year, you might want to spend a little bit of time looking at CECL and making sure that everything's just running the way that it should be. Maybe you need to tweak or refine a couple things. Maybe you need to sit down with your credit guys and talk about how you're calculating some of this stuff, that kind of thing. So just be prepared. I think that's the thing. Be prepared. The other thing is that I think the determination on whether or not CECL is doing what it's supposed to be doing, I think it's still out. I mean, I think it's going to take us a long time before we really know whether CECL really did what they were hoping it was going to accomplish at the very beginning. It probably, it may take us another decade. Being able to look back at data and look back at history and look back at the performance and basically say, okay, CECL really did the job. It really did what we were hoping it was going to do. It really kind of solved those ups and downs, those equations, the unintended tweaking, if you will, of bank executives. So we'll kind of see what happens there. But like I said, I just thought this was a good article. I thought it was a good article just to point out basically kind of what the environment of CECL is at the moment. So we're like I said, we're basically in this adopt and adapt stage, if you will. And, we'll see where we go from there. But like I said, I hope everybody found this episode interesting today. Hopefully maybe you go back to your bank and ask a few questions and say, hey, how are we doing with CECL? But if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. As always, check out some of the other content on the channel, and I will see everybody again real soon. Thanks a lot.